All right, let's jump right in. Today, we're talking about one of the most powerful signals you can find on a chart, the bearish engulfing pattern. It tells a really clear story about a power shift in the market. And by the time we're done here, you'll know exactly how to read it. I mean, that's the million-dollar question, isn't it? Just picture it. An uptrend is rolling, buyers are feeling great, and then bam, in a flash, the sellers just take complete control. This pattern, this is your heads up. It's that critical signal that the tide might be turning. It's all about learning to read the story the chart is telling you. So here's our game plan. We'll start with what this pattern actually is, and then we'll break down how to spot it. We're going to get into the psychology behind it, really understand why its location is so important, and then wrap up with a practical formula you can actually use. Let's do this. Okay, first things first. The main job of a bearish engulfing pattern is to act as a potential warning sign. Think of it as a strong hint that a nice bullish run might just be running out of gas. At its heart, this whole thing is a two-candle story. It shows up after prices have been climbing for a while, and honestly, the name says it all. You have this massive bearish candle that completely engulfs the bullish one before it. It's a loud and clear signal that sellers have just crashed the party and taken charge. Now, if you're going to use this pattern, you've got to be able to spot it correctly. It's way more than just two colored bars on a screen. There are specific criteria that make it a valid and, a powerful signal. Let's break this down visually, because it makes it so much clearer. So on the left, that's your standard bullish candle. Let's call it day one. It's just another day in the uptrend. Then you get day two, and everything changes. A huge bearish candle opens up. Maybe it pushes a little higher, but then it closes way lower, completely swallowing the body of the first candle. That right there is the engulfing action. It's literally a visual of a total reversal in thinking, all in a single day. So let's lock in these rules. Rule 1, it has to show up at the end of a clear uptrend. 2, it's always a two-candle pattern. 3, the first candle is bullish. 4, the second is bearish. And 5, this is the most important part. The body of that second bearish candle has to completely engulf the body of the first. Oh, and a little bonus confirmation. If you see a big spike in trading volume on that second day, well, that shows you there's real conviction behind the seller's move. Every pattern on a chart tells a story about human psychology. It's really about a battle between buyers and sellers. And the bearish engulfing, well, it's one of the most dramatic short stories you're ever going to find. Just think about the mood on day one. The market is climbing. Everyone who's buying is feeling pretty smart, pretty confident. The trend is their friend, right? Everything looks great as the day closes with another nice gain. And then comes day two. The market might even open a little higher, which just feeds that optimism. But then, it seems like out of nowhere, this massive wave of selling just hits the market. And I don't mean a little profit-taking. I mean a forceful, aggressive takedown that pushes the price all the way down, wiping out all of day one's gains and then closing even lower. The sellers didn't just show up to the party, they came to shut it down. This quote just nails the psychological impact. The buyers who were feeling so great just hours ago are now suddenly in a losing position. And that confidence, it flips to fear, maybe even panic. They start selling just to cut their losses, which of course just adds more fuel to the fire and can trigger a much wider sell-off. Okay, this is super important. A pattern is just a shape. Its real power, its meaning, comes from where it shows up on the chart. You could spot what looks like a bearish engulfing pattern, but if the context is all wrong, it could be a totally meaningless signal. So what's the right context? Well, if this pattern pops up in the middle of a messy sideways market, it's a weak signal. You pretty much ignore it. But if it appears at the very top of a long uptrend, especially when the price is hitting a known resistance level, that price ceiling where sellers have shown up before, that is a very, very strong signal. It's the market screaming that that ceiling is real. This is also where a lot of less experienced traders can get into trouble. They see the price pushing up towards that resistance and they jump in, they buy, expecting a big breakout. So when the market turns around and violently reverses with that engulfing candle, they're trapped. The sellers literally use the buyer's own optimism against them. All right, so we've got the theory down. How do we turn all this knowledge into a structured, repeatable trading plan? Let's talk about the CVT formula. It's a really simple way to organize your analysis. Think of it as a three-step checklist. C is for context. First, you confirm you're in a clear uptrend. V is for value. Then you identify a key price zone, like that major resistance level we were just talking about. This is the spot where you'd expect sellers to show up. And finally, T is for trigger. You patiently wait for that bearish engulfing pattern to form right in your zone. When all three line up, C, V, and T, that's when you have a high probability setup. And here's how that might look as an actual trade. You'd think about entering a short position right as that powerful second candle closes. Your stop loss, which is your safety net, an automatic order to get you out if you're wrong, goes just above the high of that same candle. That defines your risk. And for your profit target, you could aim for the next big support level down below, or just make sure your potential reward is at least twice your potential risk. Poof, we've covered a lot of ground, so let's boil all this down to the most important points that you really need to remember. Okay, let's recap the mission-critical points. First, know those identification rules by heart. Second, always remember the story it's telling, the story of confidence turning to fear. Third, context is king. Look for this at the top of an uptrend near a resistance level. Fourth, if you get a strong bearish candle after the pattern, that's huge confirmation. And finally, and this is the most important one, no matter how perfect a setup looks, always manage your risk with a stop loss. And that really brings us to the final point, which is maybe the most important of all. Look, the bearish engulfing pattern is an incredibly useful tool. It gives you a clear signal, it gives you a defined risk level, but a tool is only as good as the person who's using it. So the real question isn't just about whether you can spot the pattern, it's about whether you have the discipline to wait for the right context and then execute your plan without hesitation. That, right there, is the difference between knowing and doing.